Thank you, Theo. Thank you to Major Clark and Colonel Wimsett and the senior officers of the Salvation Army, to members of Tasmania's Parliament and representatives of local government, and to all of you, thank you for being here and thank you for inviting me to be part of today's important occasion. I've chosen to speak about inequality, something that my profession of economics probably hasn't spoken enough about over the last 20 or 30 years, which is one reason why I've chosen to speak about it. Another reason is because the failure of my profession and others to deal adequately with things that have driven rising inequality is, of course, one of the reasons for the demand for the services that the Salvation Army and other similar groups provide to people who are at the wrong end of rising inequality. When economists talk about inequality, they are often talking about two dimensions of it. One is inequality in the distribution of income. And in Australia, that's less of a problem than it is in many other countries, in part because, although we don't often recognise this, Australia's tax and transfer system does a better job of ameliorating inequality in the distribution of income than that of many other so-called advanced economies. That's partly because we do have a highly progressive income tax system. We don't, unlike most other advanced economies, rely on flat rate payroll taxes shared between employees and employers to fund much of our social security system, and our GST is lower than that of most other countries that have GSTs. But we don't do nearly as well when it comes to the distribution of wealth, either as we do with regard to income or as we do with regard to the distribution of wealth compared with many other countries. This chart here shows the proportion of both income and wealth owned by the quintiles, or 1/5, into which the Stats Bureau divides Australian households. The right-hand chart shows a more technical measure that economists use to summarise the distribution of income or wealth, called the Gini coefficient. And the Gini coefficient is 1 if one person commands all of the income or wealth, and at 0 if income and wealth are equally distributed across the entire population. So again, it indicates that income is much more equally distributed across Australian households than wealth is. If we compare Australia with other countries, we're roughly in the middle of the distribution of wealth by comparison with other so-called advanced economies. This shows that the proportion of household wealth held by the top 10% in Australia in the most recently available data was just slightly below the midpoint of the countries shown here. The distribution or the share of income held by the top 1% is likewise about in the middle of the range of so-called OECD countries. If we look at the distribution of wealth in the way that the statistics conventionally do, that is by looking at how it's changed as between the lowest, second lowest, middle, second highest and highest groups, it would seem that although wealth has become more unequally distributed, that is, the share owned by the top 20% has increased, while the shares owned by the other 4 quintiles has decreased, it hasn't changed a great deal. And we might choose to pat ourselves on the back about that. But that's not the only way of looking at the distribution of wealth, or for that matter, income, across our society. And part of what I want to do today is to apply a different lens to that, an intergenerational lens. That is to look at changes in the distribution of wealth, not between the richest and poorest, as this chart shows, but rather by age group, between the oldest and the youngest. And if you do that, as this chart shows, you can see a striking increase in the inequality in the distribution of household wealth across generations. From the young, whose share of household wealth has fallen by more than 6 percentage points over the past 15 or so years, to the relatively older, whose share of the distribution of household wealth has increased by 10 percentage points over the past 15 or so years. Now, some of that is, of course, the inevitable result of the ageing of our population, that a higher proportion of our population are aged 65 or over, and so it would stand to reason that even if nothing else had changed, their share of total household wealth would have risen. But as the chart on the right shows, it's rather more than that. The share of household wealth controlled by those aged 65 and over, of whom I'm one, has risen by more than their share of Australia's total population. And if we unpick that a little bit more, we can see that that partly reflects a significant increase in the share of financial assets, in particular superannuation, held by older people, which is kind of what you would expect, given the way the superannuation system is intended to work. But even more starkly, an increase in the share of household assets held by younger, an increase in the share of non-financial assets, in particular housing, held by older groups within our society. Whereas by contrast, of course, it's younger households who have most of the liabilities. They're the ones who, if they've been able to achieve home ownership, are the ones with bigger mortgages, taking longer to pay down than was the norm for people who are now in their 60s. And of course, these days, people who typically have student debt if they went to university, which I didn't, as a result of having been part of that, in this sense, lucky generation between the mid-1970s and the late 1980s who got their tertiary education for free. And the thing is that the assets that are more commonly owned by older households, that is to say financial assets in particular, but also investment properties, have accounted for a rising share of total Australian household wealth. And it's interesting to note that in this country, real estate and superannuation assets make up a much larger share of Australian household wealth than in any of the other countries with which you might reasonably want to compare Australia. In particular, almost 2/3 of Australian household wealth is held in the form of real estate. And a significant share compared with other countries is also held in the form of retirement income assets, superannuation in particular. One of the biggest drivers of the widening gap in the distribution of wealth across generations in Australia has been the decline in rates of home ownership. Superficially, it might seem that that decline hasn't been very big. The home ownership rate peaked at the census of 1966 at 72%, having risen by an astonishing 20 percentage points over the first 20 years of the post-war era, and has since declined by only 6 percentage points to the census of 2021. What's the problem, you might think? Well, the problem is that if you dig below that average across the entire population, you find some very striking trends among age groups. Among people aged between 25 and 34, the home ownership rate is now back to where it was at the census of 1947. Among people aged between 35 and 44, the home ownership rate is back to where it was at the census of 1954. Even among people aged 45 to 54, who, with no disrespect, are not exactly young, the home ownership rate today is lower than it was at the census of 1961. The only group among whom home ownership rates have remained unchanged are the over 65s, who account for a bigger share of the population than they did in 1966. And I've long argued, in fact for 45 years, that it's not a coincidence that Australia's home ownership rate peaked at the census of 1966, because that was the first census after a fundamental pivot in Australian housing policy, which followed the introduction of the first homeowners grant scheme by the Menzies government in 1964. Because that marked a shift away from what had been the emphasis under governments of both political persuasions in the post-war period on boosting the supply of housing, both by governments building a lot of houses themselves, but also by governments, and especially state and local governments, seeing it as part of their role to facilitate the construction of more housing by the private sector, whilst at the same time avoiding needlessly inflating the demand for housing. Ever since then, the emphasis of government housing policies under both political parties and at all levels of government has shifted towards constraining the rate of growth in the supply of housing through increasingly onerous zoning and planning laws and increasing taxes and charges on the construction of new housing, whilst at the same time inflating the demand for housing by enabling people to pay more for it than they otherwise would, by giving them cash or tax concessions that allows them to pay more for housing than they otherwise would. And so we have almost 60 years of evidence that shows that anything that allows Australians to pay more for housing than they otherwise would results in more expensive housing and a smaller proportion of the population owning it. In the last decade, there's been some recognition on the part of governments of both political persuasions and at the federal and state level that they need to do more to boost the supply of housing, and both federally and here in Tasmania, both governments are now consciously seeking to do things to boost the supply of housing, both by spending more on it themselves and by seeking to free up zoning and planning laws that inhibit faster growth in the supply of housing. But unfortunately, as we saw during the recent federal election campaign, both sides of politics can't resist the temptation to throw cash at people in one way or another that allows them to spend more on housing than they otherwise would, which, as history shows, results in more expensive housing rather than a higher proportion of the population owning it. And that is a major contributor to increases in the inequality in the distribution of wealth across generations. Those policies of inflating the demand for housing simply do not work. They exacerbate the problem. And of course, that's not the only way in which different generations have been affected by policy trends. Data compiled by the Commonwealth Bank shows unequivocally that it's been younger households who've borne the burden of the cost of living crisis in the last 3 years, typically because they are the ones with bigger mortgages, whereas people in their 60s and over have either paid off their home if they've been able to buy one during their working lives and aren't affected by higher interest rates. Indeed, in some ways, if they have fixed term deposits, benefit from higher interest rates. Or if they're on the age pension, well, they're obviously not living the life of Riley, but at least their pension is indexed for movements in the CPI every 6 months, unlike many people on wages and salaries who for much of the last 4 years have seen their wages rise at a lower rate than the rate of inflation. So it's been younger households who've had to curb their spending on both discretionary and essential items, while people in older age groups have been far less affected by cost of living pressures. Another factor that has contributed to rising inequality in the distribution of both income and wealth across generations is conscious decisions by successive governments to lower the amount of tax that older Australians pay on any given amount of income, compared with those who earn wages and salaries who are typically younger. Now, this chart shows the average tax rates paid by age group, not the amount of tax, but the average rate of tax paid on the income which they earn, and the way in which that's trended over the last 20 or so years. And you can see that not only do older Australians pay a lower rate of tax on any given amount of income than younger Australians, but that trend has continued, has become more pronounced over the last 22 years. That's in part because our tax system taxes income that is produced by wealth more lightly than income that is earned from wages and salaries. You pay tax at your full marginal rate, whether it's 16 or 17% at the bottom end, or 47% including the Medicare levy at the top end. You pay that rate of tax on your wage and salary income. But if your income comes in the form of capital gains, dividends, distributions through partnerships and trusts, rent, or through business, you typically pay a lower rate of income tax than you do on wages and salaries. And since, as we've shown, all of those assets are concentrated in older age groups, that too is a factor contributing to increases in the distribution, the inequality in the distribution of wealth and income across generations. Now, of course, some people will say that ultimately when the older generation dies off, their assets will pass to younger people and the problem will therefore solve itself. But the reality is, if you think about it, that someone who, for example, lives to the age of 85 and who has had children in his or her 20s and leaves his or her assets to their children, those children are not exactly children. 82% of inheritances by value go to people aged 50 or over. And most of those go to people who are already in the upper half of the wealth distribution. In other words, the great transfer of wealth that people know is going to happen over the next 30 years will probably exacerbate, rather than ameliorate, the inequality in the distribution of income and wealth, not simply between rich and poor, but between young and middle-aged. And Australia does stand out among OECD countries in not having any form of taxation that influences that transfer of wealth. We haven't had an inheritance tax, or death duties as they're called in this country, since the late 1970s. But the reality is that 25 out of 38 OECD countries, including importantly the US and the UK, do have them. We typically in Australia use the tax systems of the US and the UK as benchmarks to compare ours. For example, those of us who know anything about tax systems know that in the US and the UK, the top rate of income tax cuts in at much higher levels of income, both in absolute terms and relative to average weekly earnings, than they do in Australia. And many people think we ought to move our system more into line with that of the US and the UK in that regard, if not in others. Very few people recall that the US and the UK still have estate duties and that neither Ronald Reagan nor Margaret Thatcher ever sought to abolish them when they had the power to do so. Nor, for that matter, did Sir Robert Menzies during his 19 years tenure as Prime Minister of Australia. That is, I think, a weakness in our tax system that is becoming increasingly obvious. Not that I suggest that's the only thing that could be done to slow or reverse the rising tide of intergenerational equity in the distribution of wealth. It would help if governments stopped doing things that made housing less affordable, especially for younger people, and started doing more of the things that some of them are already doing to make housing more affordable, especially on the supply side of the housing market. I think there is an argument for reducing the concessionality of the tax treatment of superannuation. I don't agree with what the current federal government is proposing to do by taxing unrealised capital gains in self-managed superannuation funds. I think that is not only wrong in principle, but will have a significant number of unintended consequences. And the fact that the proposed threshold of $3 million isn't going to be indexed is also an unsavoury feature of what the federal government is proposing in that regard. But I agree with the proposition that people with large superannuation balances shouldn't enjoy more concessional tax treatment of them than people with relatively smaller superannuation balances as they currently do. A better way of addressing that issue would be, instead of taxing superannuation contributions and earnings at 15% flat, taxing them at 15 percentage points below the marginal tax rate that people would otherwise pay. That would be a fairer way of taxing superannuation contributions and earnings. I think there's a strong case for reducing the concessionality of the tax treatment of income from investments relative to the way the tax system treats income from wages and salaries, for the reasons that I outlined before. And there's a similarly good case for reducing or abolishing stamp duty on land transfers and replacing them with a broadly based land tax without the exemptions that you currently have for owner-occupied properties. And as I've said, I think there is an intellectual case, although I acknowledge it's politically difficult, for reintroducing inheritance taxes, especially in view of the substantial transfers of wealth that are going to occur within relatively wealthy families over the next 30 or 40 years. Inequality is less of an issue in Tasmania than it is elsewhere, even though we have a relatively larger proportion of our population who are in the bottom two cohorts of socio-economic status, according to figures compiled by the ABS and the Commonwealth Grants Commission. It's less of an issue here than in other states, rather more because we have a lot fewer rich folks than other states and territories do. And I suspect that the Salvation Army and other charities in Tasmania know that, because of the greater difficulty they have in attracting the kind of philanthropy that we have heard from this morning. And I applaud those organisations and the Tasmanian government for what's been announced here this morning. But the harsh reality in Tasmania is that there are simply fewer folks who have the capacity to make that sort of contribution than in other parts of the country. But we do have other problems in Tasmania here as well. In particular, Tasmania's public finances, when you include those of our GBEs and you include the unfunded liability of our public sector superannuation funds, are arguably worse than those of any other state or territory. Theo mentioned in his introduction that last year I did a review of Tasmania's public sector finances, and I said that in order to make inroads into the problems displayed in these charts, ultimately the government has to begin running cash surpluses. That is, to be collecting more in revenue from whatever source than it spends, be it on delivering services or creating infrastructure for the future. You can't pay debt down unless you have more coming in than you have going out. And in order to help governments and prospective governments think about how that might best be done, I turned to the analysis that's done every year by the Commonwealth Grants Commission as part of the way in which it arrives at its recommendations as to how the GST revenue should be carved up among Australia's states and territories. The objective of the way in which revenue from the GST is carved up among Australia's states and territories has historically, since the 1930s, been done with a view to enabling each state and territory government to provide its citizens with the same level and range of public services, whilst levying on them the same burden of state taxes as the average of all states and territories. In other words, to achieve a situation where it doesn't matter what state you live in as to the quality of schooling your kids get, the quality of healthcare you and your family get, or the quality of policing and environmental protection that your community gets. And that's one of the things that I think makes Australia a better country than, in particular, the United States, where which state you live in does matter enormously to the quality of public services you get and how much you have to pay for it. Unfortunately, that noble objective has been corrupted by Western Australia over the last 6 years, with the result that the federal government will be gifting Australia's richest state $57 billion over 11 years, $8 billion a year from next year onwards, so that Australia's richest state can continue to run budget surpluses so big that the Western Australian government resorts to accounting tricks in order to make them look smaller, and ultimately so that the residents of Australia's richest state will have better public services and lower state taxes than people who live in the rest of the country. And I'm surprised that people who style themselves as progressives, who want more spending, for example, on increasing the job seeker allowance, which I support, aren't far more critical of both sides of federal politics for having connived in what I call the worst public policy decision of the 21st century. But bringing it back to Tasmania, what the Grants Commission finds, that should be of no surprise, is that Tasmanian governments need to spend more per head on a range of public services than other states because the need for them is greater in our community, which has a slightly above average proportion of people who come from lower socioeconomic status households, who are older, who are less healthy, and so forth. Whereas at the same time, it finds that because we don't have as many rich folks, our wages and salaries on average are lower, our property values are lower, we don't have the mineral resource wealth of Western Australia or Queensland, our state government's capacity to raise revenue is less than that of other states and territories. And they fundamentally are the reasons why Tasmania gets a much bigger share of revenue from the GST than we would if it were distributed on an equal per capita basis. But the Grants Commission's figures also allow you to compare what each state actually spends on public services with what the Grants Commission reckons it would need to provide the same level of public services as other states and territories. And similarly, to compare what each state actually raises in state taxes and charges compared with what it would be able to raise if its tax regime were the same as that of each state and territory. And what these figures show is that on average, Tasmania is actually still spending a bit less per head of population than the Grants Commission reckons it needs to in order to provide the average level of services, and it raises a bit less in tax than it would if our tax regime were the same as the average of all states and territories. For me, that was a particularly important fact behind my recommendation to the government and to prospective governments that the most appropriate way of seeking to address Tasmania's financial difficulties was not to be found by aggressive cuts in spending, but rather is more likely to be found on the revenue side of the budget. Cuts in government spending across the board, which I'm not suggesting the current government is doing, but cuts in government spending across the board would disproportionately impact those Tasmanians who are most dependent on the services which the government provides. They, of course, are people in the bottom half of the income distribution to whom the Salvation Army services are so important. Whereas it is possible to structure increases in state taxes in ways that don't impact people in the bottom half of the income distribution. After all, most state taxes are paid by businesses, which means that because they're a deduction against federal company or business income tax, that 30 cents in every dollar of any increase in taxes on businesses is in effect paid by the federal government. But it's also possible to structure, for example, land taxes or motor vehicle registration fees and stamp duty on purchase of new motor vehicles in ways that don't have any impact at all on lower income households, but do have an impact on those Tasmanian households who could afford to pay a bit more tax. And so, as I said in my report, if you're a Tasmanian who can afford to buy a $90,000 car, why shouldn't you be paying the same registration fees and stamp duty on it as someone who buys a $90,000 car in Victoria or New South Wales? They're obviously politically difficult things for either side of politics to contemplate. But if we are to be concerned about the social and, if you look at other countries, political consequences of increasing inequality in the distribution of income and especially wealth, then these are challenges that not just our politicians, but all of us in this room as leaders in business or just as thoughtful citizens are going to need to contemplate. Of course, the Salvation Army doesn't get involved in discussions about politics, and I'm not expecting them to. But I hope some of the things I've said today will even if you don't agree with them, and many of you won't agree with at least some of what I've said, will nonetheless give you pause for thought, and I hope you will think about them as you're also thinking about contributing to the Salvation Army's Red Shield appeal. Thank you very much.